Oh, there's so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless.
Welcome. Today, we're going to break down one of the most critical calculations in all of finance, how we actually determine taxable income. We're going to build a simple, clear framework to see exactly how tax law arrives at that final number.
Okay, let's dive right in. At the highest level, the entire process really comes down to this one simple idea. Taxable income is your net income minus a special category of deductions we call Division C deductions. That's it. This single formula is the blueprint for everything we're about to cover. So here's our game plan. We'll tackle this in 4 parts. First, we'll look at that core formula. Then, we'll break down its 2 main components, net income and those Division C deductions. And finally, and this is super important, we'll see why the order of the calculation really matters. So let's get started with Section 1, the core taxable income formula. To really get a handle on this, we need to understand the very distinct jobs that each of these 2 main pillars of the calculation performs. And right here, this is probably the single most important idea to grasp. Just notice the really clear separation. Net income is all about this year. Think of it like a financial snapshot from January 1st to December 31st. Division C, on the other hand, is where we make adjustments that often involve money or losses from other years. So if you remember one thing, remember this. Net income is for the now, and Division C is for everything else. All right, let's move on to Section 2 and really zoom in on that first piece, calculating net income. Now, this is the most detailed part of the whole formula, and it's all laid out for us in Section 3 of the Income Tax Act. This table right here is basically our roadmap for the next few minutes. I know it might look a little intimidating at first glance, but it's just a simple step-by-step process. We're going to start at the top, add some things, subtract others, and we'll end up with our net income at the bottom. Let's walk through each of these lines, 3A, B, C, and D, one by one. The whole process always kicks off at Section 3A. The very first step is to simply aggregate, or, add up all the positive income you've earned from different sources during the year. This is going to include things like your salary from work, profits from a business, rental income from a property, and so on. Next up is Section 3B, and this part deals with capital property, so think stocks, real estate, that kind of thing. What you do here is you take your gains from selling assets and you subtract your losses from selling other assets. Now, the key is that you can only use these capital losses to cancel out capital gains. If you have more gains than losses, that positive amount gets added to your income. But if your losses are bigger than your gains, the result for this step is just 0 for now. You can't use those extra losses to reduce your other income at this stage. Okay, so once we have a subtotal from our income and any net capital gains, we move to Section 3C. This is a spot for a handful of other very specific deductions, like childcare expenses or maybe moving costs if you had to relocate for a new job. These get subtracted right here, reducing the total before we deal with any big business or property losses. And that brings us to the final step in this section, Section 3D. This is where you subtract the total of any losses you had during the current year from sources like your business or property. Once this step is done, voila! You've arrived at the final net income figure for the year. This leads us to a really important rule of thumb. The net income calculation is almost exclusively for transactions from the current year. But if you look closely at that text, you'll see a fascinating little exception mentioned right there in the parentheses. And here it is, that one exception. It's for something called listed personal property, or LPP. We're talking about valuable personal items like art, jewelry, rare coins. The rules for these are totally unique. If you have losses from selling LPP in a previous year, you actually bring them into this year's net income calculation. This is literally the only time a loss from another year is dealt with inside Section 3. That makes it a very important exception to keep in mind. So, now that we've established our net income, let's move on to Section 3 and see how this builds our final number. We're now ready to take that net income figure and start applying the Division C deductions to finally get to our taxable income. So, how does Division C actually work? Well, it's a sequence of deductions. We start with that net income number we just calculated. Then we start subtracting specific items like certain stock option benefits. And notice that 4th item on the list, loss carryovers. This is where losses from other business years finally get to come into play. We then finish up with major policy-based deductions like the lifetime capital gains deduction.
Now, this separation should make you ask a really critical question. We just saw that LPP loss carryovers are handled inside the net income calculation. So why are all the other loss carryovers, capital losses, business losses from other years, why are they handled here in Division C? What's the guiding principle? What's the logic?
And the answer brings us right back to our core principle. Division C is specifically designed to handle things that are not part of this year's core activity. Think of it as the bucket for special items, things like applying losses from past years or giving deductions that are based on specific government policy. It exists to modify that pure current year result that we already figured out as our net income. This brings us to our final section, which really ties everything together. Let's wrap up by reinforcing why this strict sequential order, calculating net income first, then applying Division C deductions, isn't just a helpful guideline. It is a fundamental, unbreakable rule of the system. This slide really brings it all home. The law forces this strict two-step process. Step 1 is all about the present. Calculate the financial result for the current year. That gets you to net income. Only then can you move to Step 2, which is about the past and about policy. You modify that result using items from other years, and that's the whole job of Division C. And here's the key takeaway. You simply cannot calculate some of the Division C deductions correctly without first establishing that final net income figure. The net income number is an input for the Division C calculation. The order isn't just arbitrary, it's a mathematical necessity that's built right into the structure of the act itself. So, let's end with a practical question. Why does this structure actually matter to you? Well, think about a big Division C item like the lifetime capital gains deduction. If you heard a rumor that the government was thinking about changing that rule, how might that affect the business or investment decisions you're making today? Understanding this framework shows you that a change in one small part of this formula can have a huge ripple effect on your entire financial picture.